Silver's headline price is the decoy. The real story is the pressure underneath it. And right now, that pressure is building in places most people never look. There is a force in this market that wants you to believe the move is done, that the rally was a one-off mania, and the pullback proves it. And there's another force, mechanical, rule-based, deadline-driven, that doesn't care what anyone believes, and it's colliding with silver at the exact worst time of year for liquidity. Stay with me, because later in this video, I'm going to give you the two scenarios for the next 1 to 2 weeks. The levels that matter, and the one signal that tells you whether this is a normal shakeout, or the kind of setup that turns into a gap move you don't get to react to. And that's where the real pressure starts. This week has been the perfect demonstration of why silver is never just a metal. It's a leveraged expression of macro, of supply chain reality, of dealer hedging, of funding stress, and of human impatience, all trapped inside a market structure that can look calm until it suddenly isn't. You've watched it already. Silver sprinting to records into late December, then snapping back hard, then snapping again, mid-70s, high 70s, low 80s, and back, like someone is yanking the cord on a spinning top. That kind of whip doesn't happen in a market that's comfortably balanced. It happens when liquidity thins and positioning becomes fragile, when a small push forces big players to do uncomfortable things. But that's not the part that matters. The part that matters is why the whipping is happening right now, and why it's happening while gold is still holding its bid near record territory. Because when gold stays supported and silver still whips like this, you're not watching a simple risk-on or risk-off story. But you're watching a market dealing with deadlines. You're watching a market dealing with forced flows. You are watching a market dealing with the difference between owning something and owning a promise of something. And if you own gold and silver, this is the moment you stop thinking like a collector and start thinking like a risk manager. Here's the conflict in one sentence. The narrative you all hear is that silver is pulling back because people took profits. But the reality is that a huge portion of the selling pressure in this window isn't discretionary at all. It's structural. It's index rebalancing. It's passive money that has to sell futures to match new weightings, not because it suddenly turned bearish, but because the rulebook says the weights changed. And when that kind of selling hits a market like silver, smaller, more sensitive, more levered, it doesn't just lower the price. Oh, it changes the tape. It changes the behavior. It forces liquidations. It hands volatility a megaphone. And it gives the entire market a test. If silver can absorb forced selling and still hold key zones, that's not weakness. That's strength you can measure. But if it can't, the math changes. The calendar is the catalyst, and I want you to feel how crowded this calendar is. Early January stacks stressors like a bad poker hand, thin liquidity still lingering after the holidays, a major commodity index rebalance window that can take several trading days, fresh year repositioning by funds, and a market still bruised from a late December volatility event that reminded everyone how quickly silver can reverse. On top of that, you're staring at macro catalysts, jobs data, rate expectations, the dollar, things that can flip a precious metals tape in minutes. So the setup is not silver bullish or silver bearish. The setup is what happens when forced futures selling meets a market where the cost of leverage can change overnight, while physical demand and industrial procurement don't politely wait for your chart to look pretty. And the next detail is what flips the whole setup, because the exposed part of the silver market isn't a secret cabal in a dark room. Its incentives in the open. It is how paper liquidity can set the headline price even when the physical market is negotiating timelines and premiums and availability. It's how the front end of the futures curve can act like a stress gauge. And it's how options and margins can turn a normal pullback into a forced unwind. That's the hidden detail. Silver's spot print gets all the attention, but the curve, how 1 month is priced versus the next, tells you whether the market is relaxed or urgent. When the curve is smooth and gently upward, that's the market saying, supply is available, time has value, carry is normal. When the curve flattens aggressively, kinks or flips in pockets, that's the market saying, immediate metal is valued differently than future promises. You don't need a conspiracy for that. You just need a deadline and a constraint. And right now, the curve behavior and the volatility behavior are telling you this market is not in a comfortable equilibrium. But that's still abstract, so let's make it real. Imagine you're an industrial buyer who needs silver now, not in 6 months, now. Or imagine you're a short futures trader who has been riding the move down, thinking you can roll your position forward like you always do. Or you were a holder of inventory who typically earns a little by lending metal or by carrying it forward. In a calm market, these players can do their routines. Roll, hedge, finance, deliver, repeat. In a stressed market, routines become expensive choices. If the front month is rich relative to later months, if near-term delivery is being priced as scarce, you get a behavior shift. Shorts feel pain not just from price, but from the cost of staying short through time. Hedgers face basis risk. Inventory holders become less willing to part with metal unless the terms compensate them. And arbitrage desks start sniffing for distortion. Can metal be moved between venues, between forms, between timelines for a spread that pays? That's how tightness propagates. Not through rumors, through spreads, through funding, through logistics. And that's where the real pressure starts. Now, zoom back to what you've actually seen in the tape. Silver recently hit record territory into late December. Prints above 80 weren't a fantasy, they happened. And then the market reminded everyone what leverage feels like. A sharp intraday reversal that took it down toward the low 70s before it stabilized again. That kind of move is a signature. It's the signature of a market where too many players are using too much leverage. And the moment the exchange, the brokers, or the risk managers decide the game has gotten too wild, the funding terms tighten. This is why margin matters more than opinion. When margin requirements rise, it doesn't matter how bullish you are. If you can't post the collateral, you sell. If you're short and you can't tolerate the volatility, you cover. If you're a market maker and the options book swings your delta, you hedge. And in silver, those hedges are not gentle, they can be violent. And the next detail is what flips the whole setup. Index rebalancing, selling, and margin-driven deleveraging can hit at the same time. One is a scheduled flow. The other is a volatility response. Together, they create air pockets, and air pockets are where weak hands are separated from strong hands. So if you've been watching this and thinking, this is manipulation, slow down. Manipulation is a loaded word. The cleaner, more useful framework is incentives and market structure. The exchange has an incentive to keep systemic risk contained. Brokers have incentives to reduce exposure when volatility spikes. Passive index funds have incentives to track the index precisely, even if it means selling into a dip. Dealers have incentives to stay hedged, which means they may have to buy when price rises and sell when price falls, depending on gamma. None of that requires a villain. It just requires math. And this move isn't emotion, it's math. Now let's stack proof the way a real macro watcher should, because one argument is never enough in this market. Proof point one, the price context itself. Silver is not meandering. It's printing big ranges and big reversals. That's a volatility regime, not a sleepy bull market. Proof point two, the calendar-driven flow. Commodity indexes rebalance in January, and when precious metals have had blistering runs, their index weights can get capped or reduced, forcing passive funds to sell futures over a multi-day window. That selling is not smart money turning bearish. It's tracking error avoidance, but the impact on a thin market is real. Proof point three, gold's behavior. Gold has been trading near record highs in the mid-4,000s per ounce, holding weekly gains even when the dollar firms. When gold holds up like that, it tells you monetary demand and geopolitical hedging demand are still present. Silver, being the higher beta cousin, can overreact both ways. That's why you get the whipsaw. Proof point four, the term structure and the shape of pricing across months. When you look across the futures chain, you can see parts of the curve that don't look like a smooth, confident contango. Some nearby months are tightly clustered, and certain later months can trade oddly relative to the pack, like the curve is being yanked at different points. That's not a trivial curiosity. That's a sign of uneven demand for time. Proof point five, the physical anchor. London is the center of the OTC precious metals world, and vault holdings data gives you at least one transparent window into how much metal is sitting in commercial vaults. Those totals can rise or fall, and the key is not to scream shortage every time they dip. The key is to understand that vault totals are not the same thing as deliverable, freely available supply. Metal can be encumbered, metal can be allocated, metal can be spoken for. So the number alone isn't the whole story, but changes in direction and pace can matter, especially when the futures market starts acting urgent. Proof point six, supply chain reality. Silver supply is not a faucet you can turn on because price went up. A large portion of silver comes as a byproduct of mining other metals, which means supply response can be slow and constrained even when silver's price is screaming. Recycling helps, but recycling isn't instantaneous either. It has its own delays in economics. That creates a world where demand shocks. Industrial procurement, investment surges can push the market into tightness faster than supply can respond. And that's the part most traders ignore. But that's not the part that matters yet. The part that matters is how these proof points translate into what happens next on your screen. Because if you own gold and silver, you don't get paid for being right in a spreadsheet. You get paid, if at all, for surviving the volatility long enough for the thesis to play out. So let OS go inside the mechanics that create the exposed moment in silver, the battle between paper pricing and physical urgency. Paper silver is liquid. It trades fast. It can be created or closed with a click. That's a feature, not a bug. Futures exist, so producers can hedge and consumers can lock prices and speculators can provide liquidity. But paper liquidity can also become a mask. It can make the market look deeper than it is when everyone is leaning the same way. Physical silver is different. It moves with friction. It has forms and assay and logistics. It has vaulting and financing and delivery schedules. When everything is calm, paper and physical are synchronized enough that nobody cares. When something gets tight or urgent, paper can keep printing a price while physical starts negotiating availability in quiet ways, through lease rates, through premiums, through delivery timing, through who's willing to lend and on what terms. You won't always see that in a headline. You'll see it in the market's behavior. You'll see it when dips get bought faster than they should. You'll see it when the curve refuses to relax. You'll see it when volatility stays elevated even after the initial shock, because the market is still uncertain about where the real balance is. And that's where the real pressure starts. Now add the options layer, because this is the layer that turns normal moves into reflexive moves. Dealers who make markets and options tend to hedge their exposure dynamically. If a lot of call options are bought as price rises, dealers may become short gamma in certain regions, meaning they have to buy futures as price goes up and sell as price goes down to stay hedged. That behavior can amplify moves. If the market pushes through a level where there's heavy open interest, the hedging flow can become a wave. This is why levels matter. Not because the line on your chart is magic, but because it S, where other people who know S, risk models, flip from comfortable to urgent. If you want a simple way to think about it, options can create a rubber band effect. When the band is stretched and the market is sitting near a strike with heavy positioning, a small move can snap into a bigger one because hedging needs to catch up. But that's not the part that matters most for the average viewer. The part that matters is what all of this forces participants to do this week. Forced index selling forces passive funds to sell futures over a set window. That selling can push price down into zones where leveraged longs get nervous. If volatility rises, margin requirements or broker risk limits can tighten, forcing more selling. As price drops, dealers hedging can sell more if they are positioned in a way that demands it. That cascade is how you get those ugly candles that feel like the market is hunting stops. Or, again, you don't need malice. You need leverage. Now flip it. Once that forced selling is exhausted, once the rebalancing window passes, once the liquidations are done, what happens if real demand is still there? What happens if gold is still supported, macro hedging is still alive, and industrial procurement doesn't pause? You can get the opposite cascade. Shorts cover, dealers hedge upward, and the market runs into a thin order book. That's how you get gap risk. That's how you wake up to a move that happened without you. And that's exactly why the calendar matters. Because the forced flows are scheduled, but the reaction is not. So here, the silver market exposed translation. The market is exposing who is here because they want silver exposure, and who is here because they want leverage. Leverage behaves beautifully on the way up and brutally on the way down. Leverage is what makes people feel like geniuses for 2 weeks and like victims for 2 hours. And if you own gold and silver, you need a viewer psychology shield right now because volatility is going to try to own you. The market's favorite trick is to make you emotionally trade a fundamentally correct idea at the worst possible time. It will spike and you'll feel late. It will dump and you'll feel stupid. It will bounce and you'll feel angry. Then it will chop and you'll feel exhausted. The goal is not to predict every candle. The goal is to separate trend signal from noise and then build rules so your emotions don't get a vote when the tape is screaming. Here's the shield. First, accept that silver can whip around violently even if the long-term thesis is correct. Volatility is not proof you're wrong. Volatility is proof the market is clearing leverage. Second, define your time horizon before the candle forms. Are you a 1-week trader, a 1-month trader, a 1-year holder? If you don't answer that, the market will answer it for you in the middle of a spike. Third, use conditions, not convictions. You don't need to be married to the bullish view. You need a checklist that tells you when the setup is intact and when it isn't. And that brings us to the near-term roadmap, because this is what you actually came for. What matters next week, and the week after, and what would confirm or invalidate the thesis. There are 2 clean scenarios, and you don't need faith to work with them. You need signals. Scenario 1 is the controlled pullback and retest. In this scenario, silver digests the forced selling and the post-shock volatility by pulling back into a prior support zone, think mid-70s and low 70s areas that have already been battlefields, then basing, then attempting a higher low. The key confirmation in this scenario isn't a dramatic green candle. It's behavior. Dips get absorbed, the market stops printing lower lows, and the curve and volatility start to calm without collapsing. Calm without collapse is important, because if volatility collapses instantly, it can mean the market has lost urgency. In a healthy consolidation, volatility can stay elevated while price compresses, because participants are still unsure and still hedging. That's constructive. The invalidation in this scenario is also behavioral. If silver loses the low 70s zone decisively and can T reclaim it, if rallies get sold hard and quickly, and if gold simultaneously loses its support and the dollar and real rates spike against metals, the controlled retest story weakens. Scenario 2 is the continuation squeeze. In this scenario, the market treats the rebalancing, induced weakness as a gift, forced selling gets absorbed, and price pushes back through the high 70s toward the psychologically loaded 80 handle. If silver reclaims 80 with force and holds above it, you're not just dealing with momentum. You're dealing with positioning stress. Shorts who stayed stubborn start to cover. Options hedging can flip into forced buying. Liquidity thins, and the market can sprint toward the prior highs in the low to mid 80s faster than most people expect. The confirmation here is not a single spike. It's follow through without giving it all back. It's the inability of sellers to push it down after the breakout. It's the market refusing to mean revert the way it usually does. And the risk in this scenario is obvious: gap risk and whiplash. You can be right on direction and still get chopped if you size like a hero. Because if this is a squeeze-style continuation, the market can still do violent pullbacks inside the uptrend. Pullbacks designed to punish anyone who's overlevered. This is why I keep repeating it. The move isn't emotion, it's math. Now, let's get specific about what to watch next week, because a roadmap without a checklist is just a story. Watch point 1, the end of the index rebalancing window. When the forced selling window is over, does the tape immediately feel lighter? Does selling pressure dry up? Do bids start stepping in? This is about flow, not feelings. Watch point 2, gold's posture. If gold holds near the mid 4400s and stays resilient even around major macro prints, it supports the monetary bid remains thesis, and silver tends to have a floor beneath it, even if it's messy. If gold breaks down hard, silver's floor gets thinner. Watch point 3, the key zones on silver itself. There's a reason traders keep coming back to round numbers and prior swing points. 70 is a line that the whole market can see. Low 70s are the recent battlefield where the market already proved it can reverse violently. Mid to high 70s are the zone that determines whether we're in consolidation or in a new leg. And 80 is the psychological and mechanical threshold where positioning can change quickly. Watch point 4, volatility behavior. If implied volatility stays elevated or even rises while price holds support, that can signal continued uncertainty and hedging demand, a setup for sharp moves. If volatility collapses while price drifts lower, it can indicate the market is relaxing and urgency is leaving. Watch point 5, the curve and spreads. You don't need to be a professional spread trader to watch the message. Does the market price the near months with urgency staying tightly clustered or inverted in pockets? Or does it smoothly relax into a normal easy carry structure? If the curve stays stressed, the market is telling you immediate metal and immediate hedging are still valued. If it relaxes, the market is telling you time is cheap again. Watch point 6, physical sentiment indicators. You won't get perfect data in real time, but you can observe symptoms. Are retail premiums staying sticky? Are large buyers reported to be active? Are certain regions showing stronger physical demand relative to the paper move? You don't need to invent numbers. You need to watch whether physical behavior contradicts the paper tape. And that's where the real pressure starts. Now, I want to address the part that can make people tune out: manipulation. Here's the truth. Silver has a long history of controversy, regulatory actions, big players, and heated accusations. But if your goal is to protect your capital and make good decisions, the productive way to talk about this is not certainty, it's incentives. Markets can be distorted by structure without anyone breaking a law. A market can be unsuppressed, in the sense that a flood of paper supply can meet buying demand and cap price temporarily. A market can be propped, in the sense that forced buying and hedging can chase price higher temporarily. The key is to stop treating price like a moral verdict and start treating it like a clearing mechanism for flows. When you do that, you stop getting emotionally hijacked by every headline, and you start recognizing the real battlefield: liquidity, leverage, deadlines, and the difference between a trend and a shakeout. So what would actually prove this entire exposed market thesis wrong? What's the clean invalidation? Here it is. If the forced selling passes and yet silver cannot stabilize, if it breaks below the low 70s zone and stays there, if gold simultaneously loses its bid and the macro backdrop turns hostile, strong dollar rising, real yields risk assets wobbling in a way that forces cross-asset liquidation, then the tightness plus absorption story is weakened. Because in that world, the market is not just clearing leverage, it's repricing demand. And you don't fight that with vibes, you respect it with risk management. On the other hand, what would confirm the thesis? If silver holds the battle zones while the forced selling is happening or immediately after it ends, if dips are absorbed rather than accelerated, if gold stays firm, And if the curve and volatility remain alive rather than going sleepy, then you have something meaningful. You have evidence of underlying demand that is stronger than the scheduled selling. That's the kind of tell that builds trust, because it's not a prediction, it's a test with a result. And that's why this week matters. This week is a live stress test of the silver market's depth. It is a live stress test of whether the rally is supported by real demand or just by leverage. And the next detail is what flips the whole setup. If the market passes the test, the same people who were forced sellers become irrelevant, and the people who were waiting for root to dip suddenly compete with each other to get in. That's when the tape changes from heavy to spring-loaded. That's when a market can move, not because the world changed overnight, but because positioning did. And positioning changes fast. Let me give you a simple way to think about positioning and why silver is so explosive. Silver is the metal where investors often want the gold thesis with extra torque. It's used industrially, so it has a growth demand story. It's monetary adjacent, so it has a currency hedge story. It's smaller, so flows hit harder. That combination makes it a magnet for momentum and a minefield for leverage. In a calm market, that's fun. In a stressed market, that's carnage. And institutions know this. They don't need to conspire to hurt you. They just manage risk. When volatility rises, they reduce exposure. When funding tightens, they demand more collateral. When indexes rebalance, they execute the orders. Your edge as a retail investor is not speed, it's preparation. It's refusing to be emotionally liquidated. It's building a plan that assumes the market will try to shake you out. Because it will. Now, let's talk about the what happens next week payoff I promised at the start, in the most practical way possible. If you're watching silver and you want a near-term map, watch 3 numbers like a pilot watches instruments. The low 70s region as your danger zone, the high 70s region as your battleground, and 80 as your ignition switch. If price is above the battleground and holding, continuation risk rises. If price is below and cannot reclaim it, the market may need more time, or may be breaking. If price slices into the danger zone and doesn't bounce quickly, you reduce the narrative and increase the caution. That's not drama, that's survival. And it keeps you from doing the 2 classic retail mistakes: chasing green candles because you feel late, and panic selling red candles because you feel stupid. Both of those are volatility traps. Both of those feed the exact people who are calm enough to buy when you can't. So here's the subtle but critical identity shift. You don't need to win every day in silver. You need to stay liquid, mentally and financially, long enough for the market to reveal itself. And this market is revealing itself right now. It's revealing the impact of passive flows. It's revealing the sensitivity to funding and margin. It's revealing how quickly positioning can unwind. And it is revealing that the real signal is not the loudest headline, it is the structure beneath the price. That's the exposure. That's the lesson. Now I am going to say one more thing that will make you money indirectly, even if you never trade a single contract. Stop outsourcing your confidence to a single forecast. Banks will publish targets. Commentators will shout, "To the moon," or "crash incoming." Most of it is entertainment. Your edge is having a framework. Framework beats forecast because framework adapts. A forecast breaks the moment the market does something unexpected. A framework tells you what to do when it does. So here's your framework in one line. Respect the calendar, track the flows, watch gold for the macro umbrella, watch the silver curve and volatility for stress, and use levels for risk, not for prophecy. And if you want to be part of a community that thinks this way, less hype, more mechanism, more checklists, stay close. Because this is exactly the kind of tape where having the right lens saves you from the market. Yes, favorite trick, making you quit right before the move that validates your thesis. One last pull forward before we close. The next week is not about being a bullish or bearish. It's about whether silver can absorb forced selling without breaking structure. If it can, the market can't unsee it. If it can't, the market will punish anyone who treated leverage like a lifestyle. Either way, you don't have to guess. You can watch the signals. And the one metric everyone must watch, the one thing that tells you whether the price is telling the truth, is whether urgency remains in the structure, whether the curve and spreads and volatility keep acting like immediate silver matters more than future comfort. Because if that stays true while the calendar pressure fades, the math changes in favor of the bulls. And if it fades too, you step back and respect the reset. That's how you stay alive in silver. That's how you keep your gold and silver thesis without letting volatility steal it from you.